3% gain for the S&P 500. What a reaction to Fed Chair Jay Powell. The Dow is up 935 points right now, just about at the session highs. Every sector is higher. Every Dow stock is higher. Energy leading the way. Communication services, technology, and materials are your three best performing sectors. You've got names like Apple, Microsoft, Tesla, Meta, Alphabet, Nvidia leading the NASDAQ right now, which is going to go out with a gain of 3.2%. That's it for me on a crazy Fed day for Closing Bell. I'll send it into overtime now with Scott Wapner. As we head into the close, take a look at the market. We are off the lows of the session, but we are still down more than 1,000 points on the Dow, about 1,100 points. We were down 1,300 just a few moments ago. S&P 500 declining 3.6%. Every sector is feeling the pain today. They're all lower. Consumer discretionary hardest hit. Utilities faring the best, only down 1%. Into the close, it's the NASDAQ that has been hit the hardest today, down less than 5%. Again, it was down 6% in the final hour. Looking a little better in the...
All right. Today is Thursday, the 5th of May. What a day. Bloodbath across the board, a lot of pain, a lot of chaos, a lot of panicking, and a lot of confusion. Despite all of that, I have to say that I got a good one for you tonight, and boy, do we have a lot to talk about or what. So let's not waste any more time, and here it is, in focus tonight. Panic party. Sell, sell, sell. What happened? Yesterday, we got the Jay Powell rally. No 75 basis points, and here we go to the moon. A rally worth $1 trillion. The technicals were looking good. The indicators almost were looking good. And the assumption was we're going to get a relief rally, perhaps all the way to at least the next reading of the CPI. However, this is what happened today. The stock market took its biggest U-turn since the early days of the pandemic, posting its largest decline since 2020. The Dow dropped more than 1,000 points. The NASDAQ fell nearly 5%, erasing all of the gains and then some. And here's the real reason behind the U-turn. Your boy Tom Lee predicted a relief rally after Jerome Powell's conference. And of course, he jinxed the rebound again. But at least Marco Kokolanovic is still silent for now. We're just waiting for Tom Lee to shut the up. But all joking aside, this is ugly action. I mean, I've traded bear markets before. Usually bear market rallies last for days, if not weeks. In this bear market, we're not even getting 3 hours worth of rebound. Every time we have a rebound, the stock market undo the rebound and then some right away, as you can see from the chart. Not even a chance. And of course, this has been a lot of pain for the dip buyers, specifically those who are buying stocks. Now, perhaps some of us are buying call options to play rebounds, and that's that. Your risk is the premium. You lose that, it's done. You're not losing anything more than that. But the problem is we're seeing a lot of folks pouring billions of dollars, their savings, their retirements, and buying the dip in the stock market over and over and over and over again. Even though it is clear the party is over, and they've been experiencing a lot of pain, the most pain since the 1980s. This is the most prolonged decline that we've seen since the 1980s. Unbelievable. On top of that, the volatility up and down, up and down, up and down is biting a lot of investors' heads off. A lot of folks are saying, I can't take it anymore. This is too much. Just get me out. I got some profits. I don't want to be too greedy here. Things are not lining up right. The volatility is too much. I can't take it anymore. Sell, get me out. And I will give you some of the sentiment indicators for my own experience today. But it's not just my clients, by the way. It's most Americans. Most Americans were feeling gloomy even before Thursday's dramatic dive in stocks. And now they fear a prolonged bear market. And unfortunately, this could be the case. I mean, we're talking about a decade plus worth of a bull market built by fake cash, courtesy of the Fed. When we unwind over a decade of a bull market fueled by insanity and irrationality where valuations didn't even make sense. But everybody pretended that that was normal. Well, now interest rates are moving higher and the unwinding of trillions and trillions of dollars is happening rapidly, and it could be a painful ride from here. According to the survey from Allianz Life Insurance Company, some 56 of people are worrying about a market crash, and 43% are too nervous to invest money in the market. Now, before the year even started, I produced a video, as you can see here, with the title, "The Everything Bubble Will Crash in 2022." And no, this was not yet another market crash prediction video. There are a lot of those all over YouTube. This was my thesis on why the stock market will crash this year. And I laid out in details using the evidence on why the high multiple names will crash along with the big caps, but perhaps commodities will hold on for a little longer. And I made the case really, really clear using the Buffett indicator along with interest rates. There was one condition absent for a market crash to happen. Now this condition is here. So you can go back and watch that video. I outlaid my thesis in details, and I sent that video to my clients, and I said, if you have the technology stocks, the high multiple names in your portfolio, I highly recommend that you take profits and move on. Stick with the commodities, stick with oil and gas. There are still good corners to invest in the stock market. You don't have to get out entirely. For example, when we talk about shale and gas, look at this. The cash flows in the gas industry, shale gas, in 2021 and 2022 so far erased $300 billion worth of losses in the last decade. So again, there are companies that are thriving under these conditions. We have no idea how long will this last, but for now, would you rather be in these companies with insane cash flows, or would you like to be in companies with peak earnings? Matter of fact, declining earnings. And I've been talking about peak earnings even before this season started, but nobody wanted to listen. Everybody said, oh, wait till you see corporate earnings and the stock market is going to recover. Nope, it was peak earnings and the evidence was there, but nobody wanted to listen. So today, and I'm only sharing this with you as a sentiment indicator, I got a lot of phone calls from my clients, and there was a lot of panic. Unlike last week, when the panic was, hey, do we need to change strategies here? And I said, not really. We're sticking to the same portfolio. But if you did not heed my warning and you still have the big cap technology stocks, software stocks, the RKK types of stocks, maybe it is time to get rid of them now. Maybe now you're convinced. This time around, this week, it was quite different. It was sort of capitulation. It was get me out. I don't care what's going on. Get me out at any cost. For example, a lot of them fought me last year when I said get rid of Apple. They said, oh, we get what you're saying. Yes, the market is going to go down. It's going to be bad. But Apple, you don't want to get rid of that stock. That's for the long run because Apple is inflation proof. It is recession proof, yada, yada, yada. And now after we got earnings, we know that the company is slowing down. Expenses are rising at a faster rate than the top line revenues. Now they're kind of convinced that, sure, we'll get rid of Apple now. We sold over $16 million worth of Apple stock today alone. Now, this is a boutique firm. We have few clients, high net worth, retirees types, folks who invented businesses before, products, and they retired. So they're not stupid. They're business savvy. They've been in bull and bear markets way longer than I've been through. And they say that this is the most dangerous stock market we've ever been through. So it's not just Paul Tudor Jones who said that earlier this week, because when you really think about it, it is everything. It is the geopolitics. It is the monetary policy. It is inflation. It is the reckless mania with insane amount of debt. It is the real estate bubble. It is the stock market bubble. It is the bond market bubble, the everything bubble. And they're all unwinding at the same time. This is the most dangerous stock market in history. But why did they panic today? What was the straw that broke the camel's back? Well, I heard a lot of reasons. Two important themes here. Number one, they kept talking about the lack of confidence in Jerome Powell, that the man is incompetent, he is still hesitant and indecisive, and inflation is going to go crazy. And this man should not be leading the Federal Reserve right now. This is a critically sensitive period in monetary history. We need somebody with confidence, with clear vision and plan of what they're going to do. We need to see the path forward. We need to see what they're seeing. But Jerome Powell remains vague. He weasel his way around, all to please the stock market. The man is still obsessed with the stock market, and it is clouding his judgment. He needs to stop looking at the stock market and do what's right for the economy, because what the stock market doesn't need and doesn't like is uncertainty. And by being indecisive, Powell is creating a lot of uncertainty. So these folks lost confidence in the Fed chairman entirely. Number two, and this is really dangerous, you gotta understand that some of these people lived through the Cuban Missile Crisis. And yes, it felt more dangerous back then, according to them. I wasn't there. But the odds of an actual nuclear war are higher now than then. And again, this is according to them. They believe, and I heard it over and over and over again today, they believe that we will see a nuclear attack. They have no clue where, but they're almost certain that Putin is going to use a nuclear bomb. This is the most dangerous period in human history, folks. We're playing with fire. Matter of fact, there were exercises today by the Russians on the Baltic coast, and they were practicing using nuclear-capable missiles. This is not a joke anymore, and our C9 leaders cannot even comprehend how dangerous this situation is, because if it happens, it will change the course of human history forever. There is no going back from that point. This is the first time, by the way, we haven't even seen this during the Cold War. This is the first time where we're having a proxy war right at the Russian borders. We're sending billions and billions of dollars worth of armament to Ukraine. This is a proxy war. I mean, listen to Nancy Pelosi.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone. And so our commitment is to be there for you until the fight is done.
And the first question is, who's we? What do you mean by we? And what is the end here? What does she mean by the end? I mean, she's talking as we are fighting the Russians. And thank you to the president of Ukraine for fighting this war on our behalf. This is what she's saying. This is a proxy war. We're spending billions of dollars on this war to the point where our weaponry is now being depleted. Tell me again this is not a proxy war. And if it is the most dangerous period of human history. Because if this continues, there will be a nuclear attack. And after that, all bets are off. Our lives could change forever. It doesn't seem that our C9 leaders can even comprehend the gravity of the situation here. But again, I'm sharing this with you to share the sentiment indicator that we have people who are very savvy with the markets. They've been through bull and bear markets longer than most of us have been through. And they say this is the most dangerous stock market in history. And I heard two frequent reasons on why that is the case. Number one, inflation and the incompetency of the Fed. Number two, the risk of a nuclear war. Now, I believe that these are fundamental concerns, but they did not drive the sell-off today. The Wall Street Journal says, yeah, the market digested the Fed's comments overnight and decided to dump the stock market. I disagree. I don't think this sell-off was led by a rethinking of what the Fed said yesterday. Jerome Powell was clear. He still believes in transitory. He's still approaching inflation with a lack of seriousness. He remains callous about the problem. We know he's behind the curve. We know at some point he will be forced to tighten the monetary policy in an aggressive manner, and that will cause an economic crash. Perhaps the stock market would crash before that because the stock market is a leading indicator. And yes, the risk of nuclear war is of a concern, a major concern for the equities market, but there was nothing new today besides the practices by the Russians. And I highly doubt that that was the reason for the sell-off. I've been watching the charts overnight and early in the morning, and I tweeted this. I don't believe that the sell-off today was due to digesting the Fed's decision. The Fed made it clear they will continue to be behind the curve by being reactive, not proactive. I believe what we saw today is a result of a surging US dollar and margin calls being triggered. Yep, I'll explain in a minute. But here's the catalyst behind the surge in the US dollar today, because you got to remember this. The dollar went down yesterday after Powell's comments. The dollar was saying, okay, the man is going to be dovish for now, and we've overdone the expectations. We were pricing in 75 basis points. Obviously, he's not going to do that, at least not right now, so the dollar goes down. But here comes the Bank of England overnight. It is clear that the sell-off is correlated with the strength of the dollar. The moment the BOE projected UK inflation to hit 10% by year-end, the dollar surged. The British pound got hammered and equities futures dropped. High dollar equals lower GDP and lower corporate margins. Maybe the relief rally yesterday was because we were under the assumption that the US dollar is topping, and now we know it is not the case. So what happened overnight? The dollar soars as Bank of England's grim economic forecast gives investors reasons to sell off treasuries and stocks. Among other things, the Bank of England painted a picture of sharply slower growth and inflation poised to rise above 10% by year end. The bank's policy statement underscores a range of risks that still remain even in the US. And here comes margin calls, which I believe was the reason behind the sell-off today, along with the US dollar. Right off the gate in the morning, we saw Shopify stock moving down big, over 15%. And it's not just Shopify, by the way. It was Etsy. It was Wayfair. Wayfair lost over 25% of its value today alone. Shopify's revenue growth slowest in 7 years. What is this an indicator for? We've been talking about it for a while now. The change in consumer behavior. When inflation continues to move higher, out of whack, the consumer is going to change their behavior. They're not going to spend more on unnecessities and products online because they're spending more in rents, in utilities, in gasoline, in groceries. And this will cause a massive problem because it pushes the economy furthermore towards stagflation. Here's more evidence for you that this is stagflation already. The headline from CNBC reads, worker output fell 7.5% in the first quarter, the biggest decline since 1947. You cannot even make this up. The pace of productivity, the pace of economic growth, the pace of economic activity is slowing down dramatically, yet inflation continues to move higher and higher and higher with no stop in sight at all. This is stagflation, and the next step is a recession. And God help us that we have this fool, this madman, Jerome Powell. At least Volcker got us into a recession. 2 painful recessions, but then we bounced quickly. This madman, Jerome Powell, could get us into a depression if he's not careful. You gotta take your pain pill either way. You want to take it now when we have a chance of perhaps having a mild recession and then bouncing again? Or do you want to delay the pain pill and take it later when you have to be even more aggressive and you cause and risk a depression, a prolonged recession? The picture will get even more dire overseas, globally, in poorer countries, because the starvation crisis will intensify. More evidence for stagflation in the economy. U.S. weekly jobless claims rise. Productivity plunges at the fastest pace in 74 years. Unbelievable. And look at this. The Fed says we're going to go to 3% by 2023, almost. Let me fix this one for you, and here it is. Yep, much better. And I'm not the only one saying that, by the way. Remember criminal insider trader Clarida, who got caught insider trading and then retired all of a sudden? Well, he now says that the Fed must raise interest rates to at least 3.5%. Jerome Powell says the neutral rate is 2.5%. This guy says 3.5%. And if this guy says 3.5%, it's actually 5.5%, if not more. I'm being generous, by the way, when I say 5%. And now, just to illustrate for you the fact that the stock market, that market participants, that the economy have no trust at all in Jerome Powell. Just a day, one day after his conference, the futures market are now pricing in 75% chance of a 75 basis points hike in June. So despite what Jerome Powell said, that he's not even thinking about 75 basis points hike, the futures market is saying, no, start thinking about it, bitch, because you will be forced to do it. And of course, when the bubble is going on, nobody cares. Nobody cares about the facts. In this channel, we presented video after video after video with the evidence on why this bubble will crash. We will have a painful period in economic history. But people said, oh, you don't understand the future, bro, technology. They said the same thing about the internet in the 90s. We're the future, bro. The economy's great, yada, yada. All the bullshit excuses, even though they were presented with the facts over and over and over and over again. For example, look at the gap between household net wealth and the nominal GDP growth. Now, you can look at this and say, hey, look at us, we're richer than ever. But the majority of that wealth, by the way, is concentrated at the top, at the 1%, the oligarchs, not the rest of us. But again, we can excuse household net wealth to run a little higher than the GDP growth. But when the gap gets so comical, as we're seeing right now, as we've been seeing in the last 2 years, you gotta restore sanity. Things will come down in sanity, whether we like it or not, whether the Fed acts or not. It's called the reversion to the mean. It will happen, and you will see household net wealth going down dramatically. What do you think the impact in the economy will be when households' net wealth collapses and goes back to the mean? And even executives, corporate executives, who continue to pump their stocks higher via propaganda in the business news media, but their actions say otherwise. The executives are so bearish, they're not even buying their own company's shares at steep discounts. You know why? Because they know stocks will go down by a lot. This dip that we're getting right now is just the beginning, so they're waiting for the right time to buy. And oh, by the way, the executives have been dumping stocks since last year. They dumped right at the top. Look at Carvana executives, for example. Look at Facebook. Look at Tesla. Elon Musk. Look at all of them. The executives dumped exactly at the top Peloton. We made a video about it. But now they're not buying their own shares back. They have the plans, 90 billion from Apple, 70 billion from Google, and it goes on and on and on. But they're not buying right now. They think stocks will go further down. But rest assured, even with all of this, guess who's buying the dip with both hands? Yep, retail investors, mom and pop, you and I, baby. But here's the problem. The retail crowd has been buying stocks, the dip over and over and over and over and over and over again, and they've been catching a falling knife over and 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 over again. And at some point, and we're getting closer to this point, by the way, they're gonna run out of cash. They're gonna lose everything, which I predicted in this channel exactly. The mom and pops who chased the mania, the lottery ticket, stocks to the moon, bro, they're gonna lose everything. But they're still buying for now. For example, RKK for Tesla witch Kathy Wood saw the biggest inflow in a year on Tuesday. They got a nice bounce yesterday, and now we know the rest of the story. I'm not saying don't play rebounds. Rebounds come and go, but de-risk your exposure in playing rebounds. Use call option spreads, for example. But this is not an environment where you want to buy the dip by actually buying stocks, by constructing a portfolio right now. There are some corners that are still working. Oil and gas, materials, defensives, agriculture stocks. But who knows how long will that last? But if you're going to construct a portfolio right now in the retail crowd favorite names, the RKKs of the world, the big caps of the world, the ending is not going to be good because remember what Jeremy Grantham said, and predicted, by the way. They shoot the mania names in the first phase of a crash, and then they move on to the mid caps. And slowly but surely, they start shooting at the big caps. This is exactly what happened, by the way, in 1999-2000, in the unwinding of the dot-com bubble. They shot the mania names, the high beta dot-com companies with no profits, with not even revenues. Think the Globe.com, for example. These were shot right off the gate. But the Qualcomms, the Microsofts, the Amazons, the Ciscos were still moving higher. Little by little, they shot Qualcomm and Amazon. And then they moved to the big caps at the time. The Ciscos, the Microsofts, and that was the end of the dot-com bubble. And this is exactly what we're seeing right now. They shot the RKKs last year, the mania names last year, they were all shot, the Pelotons of the world, for example. And then they moved on to the Etsy's and the Shopify's. And now they're moving to shoot the big caps, the Apples, the Googles, the Facebooks of the world. So what's going on with the retail crowd? Here it is. There has been a clear decline in the pace of equity inflows, with aggregate purchases on a 3-month rolling basis falling to $73 billion from $77 billion in early April, said VanderTrack. And by the way, the job of the stock market right now is to act like a vacuum machine, and it is vacuuming away the excess liquidity and excess wealth in the economy. Every time you buy the dip, they take that cash away from you and they say, thank you so much, goodbye. And that tightens financial conditions because we're not having loose money anymore. The stock market is gobbling all of that up. Continuing, as personal savings share of disposable income has now retracted to pre-COVID levels 6.2% in the US, we doubt that retail investors will have much more financial and emotional capital to continue buying the dip aggressively, particularly if equities were to experience another leg lower from these levels. Now we'll explain to you these levels in details in the charts analysis. Moreover, our view rests on the fact that the average investor is facing a 20% plus drawdown in their equity portfolio. For comparison, during the COVID sell-off, retail investors capitulated after their portfolio drawdown broke below 25%, while in prior instances, retail began net selling equities whenever the average portfolio crossed below 8.5%. Vanda also said listen to this is important. Vanda also said wealthier and older retail investors have not been so bearish in equities since 2009, and that fact, combined with more attractive cash yields, could lead them to shift part of their asset allocation toward money market funds. And this is true, by the way. My clients are older and they're wealthier and they've been dumping, while the retail investor, the younger folks, are buying. Taking a look at December 2018, when the market sell-off was driven by hawkish monetary policy at the Fed, the firm said this could translate into a negative 3% rotation from equities to cash proxy products. So the bottom line here, folks, we have a lot of concerns. Number one, the Fed is incompetent, and we cannot trust the Fed to handle this inflation crisis. We cannot trust Jerome Powell. and this is rattling the equities market dramatically. Also, the risks from this war in Ukraine are rising by the day, and sooner or later, if what we're doing right now continues, we will head into a nuclear disaster. They're gonna hit the nuclear button. We're talking about the Russians. This fantasy of thinking that we're just gonna pour weapons into Ukraine, and at some point Putin's gonna lose, pull his troops out, and then go back at the basement of the Kremlin and cry himself to sleep listening to Lionel Richie, well, that's not going to happen. If he is squeezed, he will drop a nuke. And the problem is these sheep morons in social media cheering for the war, cheering for more escalation, and saying, oh, he's just bluffing. These mentally ill morons will get us into a disaster. And it's not just them, by the way. Look at TV. These lunatic generals that they bring on all the time, the deep staters, the warmongers, this has to stop. Maybe it was justified in the beginning because in any war you have to use some sort of propaganda, but not anymore. The risks are rising too high. Number 3, we're seeing an economy that is facing stagflation, and the risk of stagflation is increasing dramatically. Matter of fact, we are already in stagflation. The pace of economic activity is slowing down dramatically. Inflation refuses to bow down. Number 4, we're seeing peak corporate earnings, and in some of them, we're already seeing massive slowdowns. When we talk about Shopify, for example, the slowest rate of growth in 7 years. Number 5, the rise in the US dollar is becoming increasingly problematic, not just causing lower GDP, but also lower corporate margins. Number 6, we're already seeing margin calls being hit. When you have a stock like Shopify down 15% in a single day, down, by the way, almost 70% top to bottom. When you have a stock like Meta, Facebook, down big from the top and down 6, 7, 8, 9% in a single day, and you have another giant like Amazon down 9% plus in a single day, down big from the top, again, margin calls are starting to hit. Wait till Tesla drops. That will be another disaster, another margin call disaster. You combine all of these factors together, and now you understand why somebody like Paul Tudor Jones said that this is the worst stock market environment that we've ever seen, and you cannot blame folks for panicking and moving the cash. Now, I am a believer that making emotional decisions and panicking in the stock market is not a good strategy. You want to dump your stocks when they're high. You want to buy them when they're bruised and beaten. But before you do that, you want to assess the macro environment, the monetary environment, and make rational decisions. So when folks panic today and say, hey, dump everything, or dump Apple, or dump Microsoft, or dump whatever I have in my portfolio, I'm done. Yes, it is a sign of some sort of capitulation, but this capitulation perhaps is justified. Anyhow, folks, we have to move on here. Let's start by covering the closing of the indices today, and here we go. Here it is, meltdown day. The Dow Industrial Average is down 1,063.09 points, or a decline of 3.12%. The Nasdaq down big, 647.16 points, or a decline of almost 5%. Wow. The S&P 500 down 153.30 points, or a decline of 3.57%. The sector's performances down across the board, a bloodbath across the board, and the laggards of the day were led by cyclicals, technology, and communication services. Absolute bloodbath. The advance to decline ratios stunning. NYSE 8% advancing versus 89% declining. The Nasdaq 13% advancing versus 83% declining. Now, usually, not always, but usually we get a rebound after we get an exaggerated ratio to the downside like this, but it could also be an ominous sign that once the supports that we're going to talk about in the charts are broken, we could see the beginning of a massive flush down. Commodities, what's going on here? It was an upside day for crude. Notice, equities down, crude oil higher. Inflation is not going anywhere. Stagflation is here. When we talk about Brent, WTI, gasoline, all moving higher by almost 0.75% today. On the bright side, heating oil was down almost 3%. But look at this. The party boy, natural gas, now at almost $9, closing the day with gains of over 4.5%. Unbelievable. Softs, down across the board, with exception of sugar, gaining a little over 1% today, but lumber was down big, coffee down big, OJ, cotton, cocoa. So there is some good news here. Perhaps we're seeing the soft landing in softs, not the bullshit softish whatever landing that Jerome Powell wants to sell us in the stock market and the economy. Not gonna happen. Anyways, metals. It was an upside day for both gold and silver. The gains were a lot bigger, but the moment the dollar started moving higher, and look at the dollar, by the way, gaining almost 1% today alone. Why? Because the British pound was down big, almost 2% today. And if this continues, even gold and silver are not going to hold. But we have a down day for platinum, copper, palladium, all down. Palladium down big, over 2.5%. On the other hand, meats, we have an upside day for lean hogs, the new big tech, gaining almost 2% today. On the other hand, we have a down day of almost 1% apiece for both live and feeder cattle futures. Grains, massive upside day for wheat, gains of over 2.5%, but we have modest gains for rough rice, corn, soybean meal, soybeans. On the other hand, a down day led by oats, down almost 3%, and then we have losses for soybean oil and canola. Moving on to the big casino, the options market. What's going on here? Notice that the volume did not move higher. We said in yesterday's video the confirmation for the rebound would be a move higher in the call options volume. This is not what we're seeing here. We're seeing more buying of puts. And again, honestly, the retail crowd who trades options, well, they're running out of cash. They lost a lot of money. So who's going to support the equities market right now? Who's going to support and sustain any rebound in this market? In any case, Apple came up at number one at around 1.6 million contracts. Around 62% of those were calls. So we're seeing more call options buying in Apple. Maybe my clients are capitulating and dumping Apple. Somebody's buying calls. We could see Apple rebounding in a mercy rebound tomorrow. Tesla, number two at around 940,000 contracts. Around 51% of those were calls. At number three, AMD. At around 550,000 contracts traded today for the name, about 65% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker LQD. These are the good corporate bonds, not the junk ones, but they're collapsing and they're buying puts, expecting more pain to come. In this case, they're buying the 106 puts for the expiration date June 17th, with expectations that the name could go down by more than 5% by then. They paid around 70 cents apiece to enter this trade. All in all, spending around $3 million. What about the ticker SPY for the S&P 500? They're buying calls. Interesting. The 450 calls for the expiration date June 10th, with expectations that the SPY could rebound higher by more than 9% by then. They paid around $1.30 apiece to enter this trade. All in all, spending around $2 million. What about the ticker ARKKKK? Once again, Tesla witch Cathie Wood. Will Cathie Wood even exist by year end? We'll see. Perhaps at zero, yet somebody's bidding for more pain to come for RKK by buying the 43 puts for the expiration date May 13, with expectations that the name could go down by more than 10% by then. They paid around 80 cents apiece to enter this trade. All in all, spending around $500,000. And here it is, the IWM, the Russell 2000. Boy, the IWM looks really, really scary right now. And they continue to buy these puts, massive amounts. This is a baby trade, by the way. But here it is. They're buying the 150 puts for the expiration date July 15, with expectations that the IWM could go down by more than 19% by then. They paid around $1.75 apiece to enter this trade. All in all, spending around $650,000. And lastly, at the bottom of the table, what about the ticker QQQ, the Nasdaq? They're buying puts again, in this case the 281 puts for the expiration date May 20th, with expectations that the name could move down by more than 10% by then. They paid around $1.55 apiece to enter this trade. All in all, spending around $500,000. Moving on to the heat map analysis, a bloodbath across the board. Yesterday was the tide that lifted all boats. Today, it's the opposite picture entirely. A bloodbath with very few exceptions, such as Kellogg's, for example, Twitter, for the obvious reasons, with Elon Musk, and Bookings Holdings reported earnings, but the name was beaten down to begin with. But besides that, this was... In regular markets, we would have said this is a bottom because this is capitulation day. This is peak panic. But you cannot say that in this stock market. This is the most dangerous stock market in history. And the reason is the headwinds are just too much. You got the Fed, you got Russia, you got China, you got margin calls, you got the incompetency by our leaders, you got corporate margins shrinking. You get insane valuations. It's really, really hard as I try, by the way, every single day to sugarcoat it for you, to look at the bright side, but sometimes there is nothing to look at here besides rebounds here and there. Maybe you stick to certain gas names, material names, defensives, but even those are going to get hit at some point. Here's some corporate news for you. Let's start by Facebook. We criticized the lunacy of Mark Zuckerberg when we covered Facebook's earnings. The spending like a drunken sailor. Why? To hire these bots and these content creators, quote unquote, or moderators, excuse me, for what? For censorship. Well, censorship is causing Meta an arm and a leg. On top of that, the insane spending on the metaverse, the lunacy of the metaverse, which is a glorified video game, by the way. Well, now Facebook is forced to freeze hiring. They're not laying off employees yet, keyword yet, but this is an ominous sign for the economy. One of the largest companies in the world freezing hiring. What does that mean? They're having a lot of trouble. They're seeing that the demand is waning down. They're seeing a lot of trouble ahead. They're freezing hiring for now. The next step will be firing employees. Watch out here. When we talk about Facebook and social media, what about Twitter? Here are some employees who are for certain now going to get fired once Elon Musk takes over. The woke employees of Twitter, the pro-deep state, pro-censorship employees at Twitter. Now they say, why bother? Why bother go to work? Right now, you're emboldened because we have a lot of job vacancies and a lot of demand. But looking ahead, we just cover Facebook freezing hiring. Where else are you going to find a job? You better pray that Elon Musk will keep you at the company. When we talk about thoughts and prayers, one cannot forget about Netflix because what a pain. Ooh, what a pain that stock is in. The company as a whole. Now the shareholders are suing Netflix for the slip in subscribers. Folks, you're seeing the theme here. Slowing growth across the board, be it Etsy, be it Netflix, be it Meta, be it Wayfair, be it Shopify. And on top of that, we're seeing the beginning of the wave of layoffs that is about to hit corporate America. Here's another one from BP. I used to own the stock, and now I'm thankful that I dumped BP and I stuck with Chevron instead because they pulled out of Russia, and now they're losing billions of dollars. Even though we have the best investment environment for energy stocks since 2006, yet this company is not performing, and the reason is the stupidity of pulling out of Russia. You lose assets, what do you think will happen? And therefore, I'm sticking with Chevron and natural gas stocks. Moving on to the heat map for the ETFs. This is a daily heat map. Again, a bloodbath across the board. International markets are down, growth down, value down, commodities down, everything is down. Energy down, cyclicals down, utilities, everything is down. Banks, KRE, all down. The only bright light here, beside the inverse indices and the VIX proxies, is UNG, natural gas, and the leverage index for natural gas, the ticker BOIL, BOIL. These are still working, but besides that, nothing is working today. Moving on to charts, and we start with the 30 minutes chart for the SPY, the S&P 500. What's going on here? Yesterday, we talked about, yes, the RSI is getting a little overextended. We got to the resistance almost to 430. We were looking for a pullback, but a pullback and then a rebound higher again. Yet the SPY lost 422 as support right away. Okay, no biggie. Perhaps it will rebound from 422 in or around that number. That didn't happen. Now we're down to 416. And at that point, the SPY erased the entire pump that we got after Powell's conference. That was an ominous sign. The rebound is not going to happen. Are we going down? We're going down where? 410.5. And for now, we stopped at around 410.5. We got a little rebound by the end of the day. If that support is lost, you're not going to see a lot of support underneath that. You're going to see a flush down. And to illustrate that, here it is, the daily chart for the continuous contract for the SPY, the S&P 500. This is clearly a reversal candle. We got rid of the entire gains from yesterday, and then some. It was looking good for the bulls. They managed to recapture a lot of support lines. The volume was going down. The momentum indicators were moving higher. Today changed all of that, not only from a candlestick pattern perspective, but also the volume went higher on a downside day. The momentum indicators are now moving down. It's not the end right now for the momentum indicators. Why? Because the most important support of 4,102 is still intact for now. Keyword for now. Matter of fact, the chart bounced pretty much to the penny from that number. All in all, look at the action in the last few days. We've been bounded within a range, a wide range. The support of 4,102, the resistance of 4,300. And the chart has been going back and forth, serving a lot of pies. Those who buy calls, they get a nice rebound day, and then the pies are served right in the face. Likewise, somebody buys puts, they get excited for a day or two, and then they get served pies in the face with a massive rebound higher. And folks, Doing the same thing over and over and over again, expecting different results, is the definition of insanity. So here's what we're going to do for now. We're not going to buy until the support of 4,300 is intact, until the chart climbs above 4,300. Because if that happens, we'll get a confirmation from the momentum indicators, and that will force a lot of short covering. There's a lot of shorting right now waiting to be covered. But folks are not covering because, why not? The stock market remains weak. Volatility is moving higher. You got to force the shorting to happen. But that will not take place until this chart climbs 4,300 and reclaim that as support. On the other hand, you're not going to short either, because for all you know, tomorrow, for example, comes out Bullard, and Bullard says we're not going to raise interest rates, I'm seeing peak inflation, whatever. It doesn't matter. Or we get a massive rebound day. You're not going to short until 4,102 is lost as support, because when that happens, more margin calls will be triggered. We will see a flush down. But right now, since we're range bounded in a very wide range, by the way, it is extremely dangerous, specifically if you have shorter dated options, or you're buying the dip straight out, or you're shorting straight out. You gotta wait for the resolution of this battle, the battle between 4,102 and 4,300. One of these two numbers will win, but until we find out, it's better to just wait in the sidelines. I have made the mistake of playing this rebounds, betting on it by buying calls, but these rebounds are not lasting for too long, so you gotta close right away. And this is not a way to trade, by the way. You buy call options at the close, you sell them at the open. We need more than that. And likewise, when you buy the puts, you buy them for a day, you get excited, the very next day you see a massive rebound. What is the point here? Let's wait for the resolution of this battle. And here's the SPX, the cash index. And again, be careful here of assuming that the stock market will crash from this point on. Yesterday was a bull trap. Today could be a bear trap. Why? Because despite the downward action that we got today, the chart have yet to break the most important support of 4,114.65. Who's to say that we're not going to get a massive rebound tomorrow and we see the chart climbing above 4,200 once again? That could happen easily. So you're not going to make any move here until one or two things happen. Number one, breaking below 4,114.65. That would be a shorting signal, or the chart breaks above 4,300. That would be a long signal. But for now, trading this insane volatility, not a wise choice. And here's the NASDAQ 30 minutes chart. Once again, the assumption was we pull back and then we get a rebound and we resume the rally because we got a resolution of Jerome Powell. No 75 basis points, at least for now. The market got what it wanted. Yet the moment we saw numbers like 320, for example, broken as support, and then 316.5, erasing the entirety of the rebound, it was clear it's not going to happen. Something more ominous is going on here. And we now lost 316.5 as support and 313 as support. The good news is it appears that we have a rebound of a double bottom formation right around 309. We'll see if that sticks or not. But again, be careful of making major moves. Why? Here's the daily chart for the continuous contract for the NASDAQ. We are again stuck in a range. The support 12,766. The resistance at 13,599. You could call that 13,600. Doesn't matter to me. But this is a wide range. We've been going back and forth for a couple of weeks now. We need to see the resolution of all of this. Either the chart climbs above 13,599, that'd be a signal to go long, or we see the support of 12,766 broken, that would be a signal to go short. The volume moved significantly higher today. This is a bad sign for the bulls, good sign for the bears. We thought we're getting selling climax. Well, now we're getting the volume moving higher again, and I believe this is due to margin calls. You get Shopify down 15% in a day, breaking an important support, by the way. That's going to trigger a lot of margin calls. You get Amazon, you get Facebook down below certain levels. That's going to trigger a lot of margin calls. So the volume is moving higher. And if that is the case, by the way, there is more where that comes from. We talked about the possibility of a short squeeze. If we get a short squeeze, if the action that we got yesterday was a short squeeze, then there is more where that comes from. So be careful here because the short squeeze could play out and intensify if we have a chart trading above 13,599. Yet the margin calls could also intensify if we have a break below 12,766. Why not wait? Why not wait? Let's wait for the resolution, folks. grab the popcorn, stay in the sidelines, and watch the show. Here's the IWM 30 minutes chart. Again, we were betting for a pullback, and the bet was, let's say we go down to 191.5, perhaps 190, and then we see a rebound higher, even all the way down to 188, and then we get a rebound higher. This is not what we got. Right off the gate, 191.5, like it never even existed. And then 188 got broken. That was an alarming sign. Now, the IWM has 1 day till the end of the week with the mission of reclimbing 188 as support again. Because if that doesn't happen, and we see a weekly closing below 188, boy, the IWM will flush down big time. Here's the Dixie, the dollar index, perhaps the chart that ended the rally today, the rebound rally, I should say. We're back above 103 as support. Yet again, the momentum indicators all extended, all pointing out that the US dollar should be topping right now. But every time we assume that this is the top for the Dixie, Tricky Dixie rebounds and climbs higher again. And vice versa. When we think that the Dixie is bottoming, it moves down even more. And hence, we call it Tricky Dixie. And of course, if the dollar moves higher, gold is not going to like that at all. Gold had a decent day, in the morning at least. It moved higher above 1,895. It reclaimed that as support. Everything was looking hunky-dory. And then came the US dollar and gold moved down. Let's do something different here. Let's zoom in to an hourly chart of gold and let's see what's going on here. We have support, intraday support at around 1,872. Yet gold is forming a bear flag pattern. If this support is broken, there is a likelihood for more downside. If that support is retained, we can move higher in gold, but we have to see the dollar cooling down. The dollar is on fire. And we cannot rally gold and silver and Bitcoin for that matter if the dollar and the 10-year yield are moving higher. What about Brent? Crude oil, 4 hours chart. We got a massive pump in the morning. Crude was moving higher, and then came the rally of the US dollar, and crude took a leg down. Is it a reversal or not? That remains to be seen. It all depends on what the dollar is about to do next. If we see a continuation of the rally in the Dixie, in all likelihood, oil is going to struggle to move higher. And here's a monthly chart for natural gas, the Henry Hub. We're now getting closer to 9, which was the previous stop at around, let's say, 2007. And that is an important resistance, by the way. If broken, we could see a massive rally in natural gas in a last hurrah kind of rally, just like we saw back in 06 and again in 08, where natural gas spiked significantly higher, all the way beyond 10. And bear in mind, we covered in this program before, the mystery trader who bought the $10 calls on natural gas before the squeeze even happened. They're setting on a massive, massive gain from that trade right now. And here's the 10-year yield, the daily chart. We thought, once again, that Jerome Powell marked a temporary top for this chart and the dollar for that matter. What do you know? Today both are moving higher. As if the bond market is saying, Mr. Powell, you're wrong. We don't believe anything you say. You gotta move interest rates higher. And remember this, it's not really up to Powell. The bond market is dictating the move higher. And up until recently, the bond market was saying, okay, we'll believe Jerome Powell. If Jerome Powell is dovish, we move down in yields and we move higher in bond prices, the TLT and the likes. But now, and this is really interesting, now the bond market doesn't believe Jerome Powell at all. He can be as dovish as he wants. The bond market says the reality of inflation is going to force you, Mr. Powell, to do whatever the hell we want you to do. And right now, we see higher yields, higher interest rates. When you say it's going to be 3% by the end of the year, actually he says 2.5%. It's genius. This chart says 3% by the end of the year for the Fed funds rate. And if it continues to move higher, then it's going to be 3.5, 4, 5, 5.5. And Jay Powell will not have any choice but to be forced to do what the bond market is asking from him. And here's the weekly chart for the TLT. A lot of pain. A lot of pain. No stop inside here. Yes, extremely oversold, but how can you see a rebound from this point on? We're talking about a bull market in bonds for what, 40 years plus now? Well, when you unwind a 40 years plus worth of a bull market and everybody rushes to the exit door at the same time, this is what you get. And we're not going to know where the bottom is until we know. For now, you cannot fight the Fed. You cannot buy this chart and fight the Fed. We have to wait for more clarity. Here's the VIX 4 hours chart, and this is really important. I tweeted today and I said, yesterday was a bull trap, today could be a bear trap. So watch out here. Why? It was a massive down day in the equities market, but the VIX did not move higher. One would think that the VIX in a day like this would climb significantly higher. This was not the case. Yes, from the bullish side of the VIX, there is progress, and we're talking about the recapture of the trend line of support. But the problem is, the VIX, we can't say rejected for now, but it is facing stiff resistance at around around 33, as you can see from the last candle. On top of that, we're seeing the RSI still in negative divergence. And another point, what if this is a head and shoulder formation? If that is the case, then today was a bear trap in the equities market, in the SPY in particular, because if the head and shoulder pattern plays out, the VIX will go down again, and we will see a rebound in the SPY. Therefore, wait till the critical support or resistance lines that we just talked about in the SPY and the Qs are broken one way or the other. Otherwise, this is just too volatile. This is head spinning action that nobody wants to be involved in. Yes, I know there are geniuses out there who say, hey, all what you have to do is just buy calls in the SQs and you're going to win. Others say, hey, just buy calls and T-triple-Qs or whatever, and you're going to win. These fools pretend that they know what they're talking about, but right now, nobody knows what they're talking about, including me, by the way. In this wide range of volatility, things could go either way. We're seeing massive upside days and massive downside days. We gotta wait for a break one way or the other. Here's the VXN, and this is a 4 hours chart. Again, when we talk about a bear trap, what do we mean by that? It was supposed to be a massive day for the VXN. The Nasdaq was down over 5% at some point, but again, we did not see a massive move higher. On top of that, we're seeing negative divergence on the RSI, and the MACD indicator is still showing red impressions on the histogram. Watch out till the resolution happens between the critical support lines and the critical resistance lines and the Qs. Here's another sign that today's action could be a bear trap. Why? Look at Apple. Apple is down big, but it stopped at 157 as support. The critical support lines are not being broken despite the massive down day. Yes, the volume is moving higher. Yes, the momentum indicators are moving down again. All of these are signs that we could see more pain to come. But you're not going to know that for sure until 157 is broken as support for good. Here's Tesla, an hourly chart. What's going on here? Another flush down, and it is keeping around 866.14 as support for now. It did not make it all the way to 995. This is a weak link in the Nasdaq, and the reason is the involvement of Elon Musk with Twitter. He's overpaying for Twitter, no doubt about it. If this stock goes down, it could trigger a lot of margin calls. Now, this is the time if you're a big shot investor like the big short Michael Burry, for example, and you have access to hundreds of millions of dollars, this is the time to place a short in Tesla. Now, for retail investors like you and I, we cannot short this name because to make the trade worthy, you got to short at least, let's say, 100 shares. And even with that, it's not really worth it. You got to borrow at least 1,000 shares to make it worth it. But that's a lot of risk. We're talking about over $1 million. So we're not going to do that. We're going to short via put options. The problem is, until we get the resolution in the Nasdaq, this is not the time to short Tesla via put options. We got to see more support lines being broken. We have to see the sentiment within Tesla culties being broken. For now, from a trading perspective, be it calls or puts, there are more and better opportunities beside this stock. And here is Bitcoin, a 2 hours chart, and the pattern we talked about yesterday was a bull trap, clearly. And the chart flushed down all the way to the next support we've been talking about for a while now, 35,750. And so far, at the time of the recording of this video, we're not seeing a sizable rebound, so we have to wait and see here. You're not going to buy BTC again until we have risk on. It appeared that we have risk on yesterday after Jerome Powell's remarks, but today we know we don't have risk on. We did not get any confirmation that this is risk on. And by the way, look at this. This could be another great short. MicroStrategy, drunk Michael Saylor, he says if Bitcoin goes below 21,000, MicroStrategy will get hit with margin calls. So if Bitcoin goes down to 30, 28, 25, in all likelihood it's going to break 20,000 as support. So you want to short MicroStrategy. And here's AMC. This is a 30 minutes chart. Yesterday we talked about not making lower lows. And that was a good sign that perhaps AMC could move higher. The problem is we're not making lower lows in a flush down way, in a decisive way, but we made lower lows today. I would have preferred if AMC went down all the way to the support of 1424 and then get a rebound from that point on. But for now, you cannot take the action for granted. But here's an important point. If 14.24 is broken as support, AMC will flush down big, all the way to 10, if not 5. So breaking the support will be a massive shorting signal. Now, like Tesla, this is a cheap stock to short. And I know that the AMC apes will say, wait for the short squeeze, the holy short squeeze, you're going to see. Not after you break 14.24. There is no short squeeze. You're going down to zero. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the most important non-farm payrolls, and then we have consumer credit. On top of that, we have multiple Fed zombies speaking. Number one, the king of doves, Williams from New York. That could be good news for the bulls, that perhaps Williams would say, hey, I'm not going to vote for 75 basis points. Matter of fact, I think 25 is more appropriate from this point on. That could initiate a rally higher, a rebound, but we also have the bull slayer from St. Louis, Fed zombie James Bullard, and he could say, hey, I think 75 or even more is appropriate. Then equities are going down again. And lastly, what do we have on the earnings calendar? We have Under Armour. That's it. But rest assured, we're going to cover all of these earnings. Well, not all of them, but the most important ones in a separate video. But for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again over the weekend. In the meantime, keep your head up and take it easy.